We bring in William Lee now, Chief Economist at the Milken Institute. Welcome again, joining us from Singapore. Hey, good to see you. John mentioned that Europe was a potential factor in volatility. I mean, I have obviously my opinions on this, but let's start with Europe. That sort of was the instigator of all the market volatility starting from February. Do you think the world has put its arms around the risk factors around Europe yet? In other words, is the worst behind us?
Not even close. I think the world is yet to understand just how deep Europe is in terms of the risk for the recession needed to control inflation. In Europe, most of the inflation is coming from energy. So really it is beyond the control of the central bank. But the central bank nevertheless has to meet its mandate, which is to say, make demand meet wherever the supply is. And if supply is being constrained by energy, then lower demand to the point where we equilibrate supply and demand and we get rid of the inflation, because that's the mandate for every central bank, especially the ECB. And the ECB has really hesitated and acted very slowly and is way behind the curve.
So Europe's not doing well, and here in the U.S., you know, if you look at the S&P 500, year to date, it's down 25%. The Nasdaq's down 33%. I got plenty of numbers to share with you. They're all bad numbers. And my point is, it brings down the confidence of investors. It brings down the confidence of consumers. And we may not be in a technical recession yet. I'm not sure it matters at this point, but all of my circle of people, everyone's talking about it. We're going to cut back on spending. We're going to be more conservative. And ultimately, I don't see how this is good for the economy, but I guess it will at least maybe bring down inflation, right?
Well, Phil, like everyone else, my 401k is now a 201k, right? It's more than gone by more than half. And I think if everyone behaved the way your friends behave, we would actually not have the kind of fears and uncertainties that we're facing. The markets wouldn't have to crash as much because inflation would start to turn around. Unfortunately, too many people are still spending. Too many people are not concerned that they're going to be losing their jobs. And until we actually get that kind of behavioral change, the Fed's going to say, all right, we just have to keep pushing harder and harder on interest rates and make the risk of recession even higher for people to stop spending.
But it doesn't make sense, though, because you want to crash the economy, essentially, raise unemployment rates, make people sad, destroy consumer spending, which is a huge part of the economy, for what? Just to say that you got inflation under control?
Phil, back down. Remember, the biggest problem facing inflation now among the U.S. Consumers and citizens and the electorate, the biggest problem now is that the economy is doing badly because of inflation. That's 7 out of 10 people are saying that is the primary problem in the United States, high inflation, because it's cutting into their budgets. And so the Federal Reserve's mandate is not only just full employment, but also price stability, and that's where the Fed is going. And right now, because not enough people are cutting back on spending, we're not seeing a turn in inflation. It continues to rise. The latest numbers on the PCE deflator show that we still have incredibly high inflation, way higher than the Fed's 2% target. People don't believe the Fed is going to be able to achieve its goal. And so it's going to have to convince people by saying, if you don't stop spending, you're going to lose your job. And they're going to be serious about it.
Why not wait? Why can't we wait? I mean, you and I know you agree with this, but when the Fed raises rates, it takes quarters and quarters before it finally kind of goes into the economy. Are we that impatient that we need Jerome Powell to say, there's pain coming, we're going to raise rates, and you and I have to stop spending next week? It just seems to me that what we're expecting is not realistic.
What we learned in Economic 101 was the long and variable lags of monetary policy. Well, now, because the Fed's been so transparent, central banks around the world have been so transparent and said, look, we are going to be doing this, markets have started to react much faster. So the lags themselves have actually shortened. And what the Fed is not seeing is any kind of impact from its tightening since March. And that's why the Fed has got to be more aggressive, because it really has lost the credibility. And we're dangerously close to the world of the wage price spirals of the 70s and 80s. And if that happens, everything's out of control.
Do you think I see evidence of it. I mean, wages are going up. I think productivity might be going up, and we haven't even seen the beginning of these wage hikes. Amazon came out and said they're going to raise wages. A number of companies have all said that, and this is going to happen here in the months and months and months to come. So we're at the very beginning of this.
If the Fed is not successful in convincing everyone that in about 2 years, we're going to have 2% inflation. And so you're not going to have to raise wages up to the 7 or 8% levels that you think you need to catch up. And that's the key. If people are not believing the Fed, we're going to get a massive recession. If, in fact, people start to cut back on their spending and they start to believe this and not demand the 7 or 8% wage increases and stay with 3 or 4 or maybe 5% increases, then we will not have a severe recession. The economy itself is very adaptive. It has to be believing in the policies that are in place.
Fair enough. William, I'm not going to let you go because you're coming to us from Singapore. And by the way, thank you. Give us one bit of good news.
The optimism here in Asia is really palpable. People are saying we're looking for business opportunities. The Milken Asia Conference was all about opportunities, and people are talking that there is a lot of opportunity in ASEAN. And quite frankly, Asia is not just China. There's a lot of opportunities in investments, and we see a lot of investment flows intra-ASEAN and Korea.
Appreciate the time. Good to see you as always, William. Thank you. Safe travels.